While California homeowners panic over the biggest price drops in over a decade, smart investors are seeing something completely different: historic buying opportunities. If you've worked your entire life, saved your resources with discipline, and now seek to invest your retirement funds into assets that generate solid passive income, this is exactly the moment we've been waiting for. Prices melting between 7% and 13%, desperate sellers, and entry windows we haven't seen since 2009. Welcome to Keynomics, where we transform market corrections into winning portfolios. If you want to know where your capital can work hardest right now, subscribe to the channel, turn on notifications, and stay until the end because we're revealing the 8 cities where the discounts are deepest. For years, California's real estate seemed invincible. Prices climbed relentlessly, demand exceeded supply, buyers competed fiercely. But in 2025, the game changed completely. Property listings pile up, vacancy rates climb to 2009 crisis levels. Owners slash prices monthly just to sell. Excessive pandemic construction, slowing migration, and stratospheric living costs triggered a correction experienced investors patiently awaited. Residential prices in several California cities fell 7% to 13% over the past year. Homes commanding premium values now sit months without buyers. The result? Motivated sellers, aggressive discounts, negotiating conditions favoring capital investors. For retirees diversifying portfolios with income-generating tangible assets, this moment offers entry points unthinkable 2 years ago. Remote work fueled 2020-2022 migration, now reversing as companies recall employees. Thousands who fled to peripheral cities now sell and return to urban centers or leave California entirely. Developments that seemed safe bets face double-digit vacancies. Luxury condos with waiting lists now offer move-in incentives and free rent. For investors understanding market cycles, each negative headline represents a value buying opportunity. Today on Keynomics, we reveal 8 California cities where prices melt fastest and what this means for investors building real estate portfolios. We'll identify where long-term appreciation opportunities are most promising. California's demographics, diversified economy, and global innovation hub position guarantee this correction is temporary. The question isn't whether prices rise again, but when and who has discipline to buy when everyone sells. 8. Long Beach. Long Beach was LA County's quiet success story. Ocean views without Malibu prices, urban quality without LA chaos, port economy guaranteeing stable jobs. But vacancy rates climbed to nearly 10%, highest since 2008-2009. The median 2-bedroom dropping from 2,750 to 2,400 reflects directly in investment property values. Luxury towers cut prices hundreds monthly. 2 months free signs replace waiting lists. Pandemic developers bet coastal demand would never slow. Return to office disproved that. Hybrid workers depart, insurance premiums up 20%, utilities climbing, rent control pressuring smaller landlords to sell. Yet Long Beach remains California's second busiest container port, a logistics hub with permanent locational advantages. For retirement investors, properties commanding bidding wars 2 years ago now have motivated sellers. Rental units at today's depressed prices lock in positive cash flow while positioning for appreciation when markets stabilize. 7. Sacramento. Sacramento offered affordable government job stability. Pandemic remote workers flooded in from Bay Area, driving prices up 40% in 2 years. That boom reversed with stunning speed. Vacancy rates hit 9.2%, rentals dropped 7% year over year. 3-bedroom houses struggling to attract tenants show market cycles create best entry points. Return to office hit hard because growth was predicated on permanent remote work. Tech workers face brutal commutes or selling. Construction oversupply haunts the market. Yet Sacramento's fundamentals remain rock solid. State government employment doesn't disappear during cycles. Central location, significantly more affordable than coastal markets. For retirees deploying capital, buying rental properties at today's depressed prices locks in cash flow while positioning for appreciation. This isn't speculation. It's buying quality assets when temporary factors created artificial discounts. 6. Oakland. Oakland was San Francisco's affordable alternative, where young families could achieve homeownership with Bay Area proximity. Vacancy rates surged past 10.5%, rentals plummeted 11%. Modern one-bedrooms commanding $3,200 in 2022 now advertise $2,700 with 2 free months, effectively dropping annual costs nearly 20%. Downtown towers stand partially empty with unprecedented incentives. Return to in-person work eliminated Oakland's pandemic advantage. Tech companies calling employees back to San Francisco left vacant apartments. Yet Oakland's long-term thesis remains intact. Sitting directly across the bay from one of the world's wealthiest regions, BART connectivity provides San Francisco employment access without San Francisco prices. Port of Oakland ensures stable employment independent of tech volatility. Oakland's current prices relative to San Francisco create a value differential that historically always narrowed. For retirement investors seeking income properties with appreciation potential, this represents classic contrarian play, buying quality assets in temporarily distressed markets. 5. San Diego. San Diego's diversified economy supposedly insulated it from boom-bust cycles. Military installations, biotech sector, defense contractors offered stability that tech-dependent cities lacked. Yet prices dropped 7%. Vacancy rates climbed beyond 8%. Two-bedroom apartments falling from $3,200 to $2,900. Luxury coastal properties in La Jolla and Pacific Beach sitting 6 months on market show harsh market realities. Pandemic construction boom planted oversupply seeds. Developers rushed to build luxury apartments across downtown and Mission Valley, assuming demand would never slow. When that proved wrong, thousands of new units hit the market simultaneously. Insurance premiums jumping 25% in coastal areas forced landlords beyond market tolerance, some raising rents beyond what even biotech professionals will pay. But San Diego's investment case remains compelling for patient capital. Military installations, Naval Base San Diego, Marine Corps Air Station Miramar aren't moving, providing permanent employment demand that transcends economic cycles. Biotech cluster continues growing, with major pharmaceutical companies expanding research facilities in Torrey Pines and Sorrento Valley. Border with Mexico creates unique cross-border economic dynamics supporting long-term growth. Climate and lifestyle advantages ensure sustained demand from retirees and high-income professionals regardless of short-term fluctuations. For retirement investors seeking rental income in markets with proven resilience, San Diego's correction offers exactly what value investing demands: temporary price weakness in assets with permanent advantages. The 7% drop isn't avoidance signal. It's invitation to acquire quality properties at valuations that won't last once oversupply absorbs. 4. San Francisco. Once undisputed king of American housing appreciation, where bidding wars were routine and million-dollar starter homes were bargains, now leads California in price declines. Median prices dropped 3.8% year over year, with some neighborhoods seeing steeper falls. Vacancy rates soared past 11%, a figure unthinkable during tech boom years. For investors understanding greatest fortunes are built buying elite assets during temporary distress, this presents once-in-a-generation opportunity. Remote work decimated downtown office occupancy, tech layoffs at Google, Meta, Apple eliminated tens of thousands of high-income households who were primary housing demand source. Luxury condos in Soma and Mission Bay that sold $1.5 million in 2021 struggle at $1.2 million, a $300,000 haircut. Historic Victorian homes in desirable Noah Valley, Cole Valley, and Hayes Valley sit months on market, something unheard of during boom. Even iconic properties in Pacific Heights and Russian Hill have seen price reductions that would have been laughable 5 years ago. Developers converted underused office buildings into residential units, ironically deepening the vacancy crisis they meant to solve. Yet San Francisco remains world premier city with irreplaceable assets. Its concentration of venture capital, technology headquarters, innovative companies ensures long-term economic vitality regardless of current headwinds. Geographic constraints, surrounded by water on 3 sides, permanently limit housing supply in ways guaranteeing future appreciation. Cultural amenities, world-class restaurants, natural beauty maintain appeal to high-income professionals globally. San Francisco weathered multiple boom-bust cycles over decades, always recovering to reach new price peaks. For retirement investors with patient capital, San Francisco represents ultimate contrarian play. Buying premium properties at 20 to 30% discounts from peak prices locks in generational wealth building opportunities. Rental properties purchased now can generate positive cash flow while positioning for inevitable appreciation when tech sector stabilizes and remote work policies mature. Investors who built Bay Area fortunes did so buying during dot-com crash of 2001 and financial crisis of 2009, both times when headlines screamed San Francisco was finished. Today's distress will look like yesterday's opportunity when we review these markets 5 and 10 years from now. If you're still watching, hit that subscribe button and notification bell for Keynomics. We bring you these investment insights weekly. Drop a comment telling us where you're watching from. Now let's reveal the top 3 cities where prices are falling fastest. 3. Riverside. Riverside became California's affordability valve, absorbing families priced out of coastal markets. Developers convinced remote work permanently changed preferences. That illusion shattered with remarkable speed. Prices dropped nearly 10%. Vacancy rates surged 9.4%. 3-bedroom houses that sold $550,000 in 2022 struggle at $495,000. Remote work reversal hit hard. Logistics sector softened as e-commerce decelerated, Amazon scaled back expansion, insurance and utility costs ate household budgets. Yet Riverside's fundamentals remain sound. Warehouse and distribution networks serve entire western U.S., positioned between LA and desert communities, ensures logistics demand. Even after drops, Riverside offers value ratios relative to coastal California that historically always attract buyers. For retirement investors seeking positive cash flow with appreciation potential, today's prices offer what the boom couldn't. Actual investment returns making mathematical sense, not speculation. Buying real assets at real discounts with real yield. 2. San Jose. Experiencing significant declines feels surreal. Modest ranch houses routinely sold $1.5 million. Tech workers competed with cash offers. Corrections seemed impossible. Yet prices dropped 12%, vacancy rates surged above 10%, levels not seen in 2 decades. Tech sector restructuring explains the pain. Layoffs at Google, Meta, Apple, PayPal eliminated tens of thousands of high-income households. Remote work freed geographic constraints, allowing relocations to Austin, Denver, Salt Lake City. 3-bedroom homes commanding $1.8 million now sit at $1.5 million with negotiable terms. But dismissing San Jose ignores fundamental advantages. Global epicenter of technology innovation, home to more patents, venture capital, billion-dollar startups than anywhere on Earth. Major tech companies aren't leaving, despite current layoffs. Engineering talent ecosystem, research universities, innovation infrastructure can't be replicated. Geographic constraints and restrictive zoning permanently limit supply, guaranteeing future scarcity. For retirement investors with substantial capital and long horizons, San Jose represents perhaps most compelling opportunity. Buying premium properties in world's wealthiest innovation hub at 10 to 15% discounts is exactly how generational real estate wealth builds. Investors with courage to buy during dot-com crash and financial crisis are today's multimillionaires. Current distress will look like historic opportunity when AI, biotech, clean energy drive next Silicon Valley prosperity wave. 1. Bakersfield. Most surprising, Bakersfield. California's blue-collar stronghold where working families achieved homeownership and modest investors generated reliable cash flow. Yet vacancy rates exploded past 12%, highest statewide. Prices dropped 13%, California's steepest decline. Developers assumed temporary trends were permanent, rushed to build thousands of units betting LA refugees would continue forever. When growth stalled and remote work rolled back, demand evaporated overnight. 4-bedroom houses that sold $425,000 in 2022 struggle at $370,000. Agriculture hammered by drought and automation, logistics contracted, oil employment below historical levels. Yet beneath negatives lies opportunity sophisticated investors shouldn't ignore. Bakersfield's fundamental role as California's agricultural heartland hasn't changed. Central location provides transportation corridor access. Most importantly, today's depressed prices offer yields and cash flow ratios that don't exist anywhere else in California. Single-family homes generating immediate positive cash flow. Entry prices low enough that modest appreciation generates substantial percentage returns. Market correction cleared speculative excess, leaving serious investors and long-term owners. For retirement investors seeking maximum cash flow, Bakersfield at cycle bottom represents exactly what income-focused investing demands: properties paying for themselves day one while positioning for appreciation when oversupply absorbs. Not about prestigious addresses, building portfolios, generating monthly checks regardless of conditions. From San Francisco to Bakersfield, California's real estate undergoes historic correction, creating opportunities not seen since financial crisis. Prices falling, sellers motivated, patient capital has leverage. For investors who built retirement savings and now seek income-generating real estate deployment, this moment demands attention. The question isn't whether California housing appreciates again. It's whether you'll have discipline to buy when headlines are negative and everyone fearful. At Keynomics, we don't follow crowds. We analyze data and identify opportunities others miss. Every week, we bring market insights for experienced investors understanding corrections create wealth. If you're serious about building real estate portfolios generating income and appreciating over time, subscribe to Keynomics now and hit that notification bell. Share this with fellow investors who need to see where California's best opportunities hide. Take action while windows remain open. In real estate, greatest fortunes are built by those who buy when others panic and sell. Your retirement deserves portfolios built on value, not hype. Let Keynomics show you where to find it.